Welcome to your monthly investment update. I'm Neil Alexander and I'm the CEO of Nutmeg. This month is a bit of a departure from our usual format. Like most businesses in the UK, we're following the government's guidance on social distancing and working remotely. So instead of filming the investor update at our headquarters, we're doing it at our homes on Zoom. But don't worry, we'll be covering all the usual topics and we'll make sure that you're kept up to date. So today I'm joined by James McManus, our Chief Investment Officer. Hi, James.
Hi, Neil.
Are you keeping well?
Can't complain.
Excellent. Right, James. So the past month has been one of the most eventful periods in the market since Nutmeg was founded back in 2012. Can you tell us what happened?
That's right. So March has really been quite a historic month for financial markets and for the global economy and society as a whole. It won't surprise anyone, given where we're sat today and how we're currently operating our business remotely, that there have been significant changes in the way that we all live and work in the past month. In fact, so much has changed in such a short period that it's sometimes difficult to remember that it's only been 4 weeks or so, rather than months in themselves. So from a financial markets perspective, the month really started on a weaker footing. In February, markets had been caught off guard by the more prevalent spread of COVID-19 outside of China, where it had seemingly been controlled. And the advance of the disease into Europe and the US in early March drove a rapid adoption of containment measures that financial markets simply weren't adopting as their base case. That is, the disease moved quicker. The actions to halt its advance were largely more restrictive to activity than anyone initially imagined. Now, the velocity of the news flow was also matched by the velocity of market moves, and we saw market volatility accelerate past even the peaks we saw in the financial crisis, as investors tried to rapidly understand and digest what these changes meant to the business operating environment globally. The fast-paced nature of that news flow made this especially challenging, and that's why we witnessed one of the most volatile months we've seen for many years.
Right. So market volatility is, of course, something that we in the industry or as investors talk about a lot. How extraordinary or not has the volatility been that we've seen in March?
Well, I think the answer is pretty extraordinary. Some of the moves we've seen in financial markets over the previous 4 to 6 weeks have been historic, and maybe I can give you a feel for that, with a feel for the magnitude of some of these events with a number of the records from this past period. So in the US stock market, we've witnessed the fastest bear market, a fall of 20% from the market's peak in history, just 16 days to reach that negative 20% marker. This compares with over 8 months to reach the same point in the financial crisis in 2007, 2008. We've witnessed the third and the sixth biggest daily losses in history in the US stock market. And we've had the first 3-day period since 1933 with more than a 9% loss or gain on each given trading day. But we've also seen the biggest 3-day gains since 1933 as well, and 2 of the top 15 biggest 1-day gains in history in the US stock market. Alongside that, we've also seen the global oil price fall significantly to levels last seen in 2003. Volatility, as I mentioned before, reached an all-time high, exceeding even the levels reached in the global financial crisis. And US government bond yields reached all-time lows. Closer to home in the UK stock market, we've also seen the worst 1-day loss since 1987, but also the best 3-day gain since 1979. So we've seen relatively unprecedented moves in markets over the past month, at least in modern times, and in the face of unprecedented disruptions of the global economy. But we've also seen an unprecedented reaction in terms of 3 types of policy response: medical, fiscal, and monetary. I've already touched on the medical response, but this continues to advance, and we expect to see some improvement in the medical data as lockdowns and social distancing have an effect. We've also seen a significant and far-reaching monetary policy response. This is the response from central banks to lower interest rates, to free up liquidity in the system, and to promote orderly financial markets. And we've seen interest rates slashed globally, alongside other initiatives such as the Federal Reserve, the US Central Bank, announcing its commitment to unlimited quantitative easing, the purchasing of securities, all designed to try and seek and to support financial markets. But we knew going into this crisis that central banks had less room to cut interest rates than in previous economic cycles, given the relatively low starting point. And so we've also needed governments to take up more of the burden. And there we've also seen some really meaningful fiscal policy implementation too. So these are the policies that we need from governments to support businesses, support workers in the economy. And these are the policies that can have a quicker economic impact. They help secure jobs, they support businesses, and they stop this temporary shock to activity becoming a much deeper and prolonged recession. In the UK, the fiscal package has exceeded what was delivered in the financial crisis. And we've also seen really meaningful packages delivered in Germany and the US that represent about 10% of the gross domestic product in both of those countries.
Wow. So, I mean, there's some real staggering facts and figures there that you've covered. And given the volatility we've seen and the actions that you've talked about, where did the major financial markets finish this month?
Well, global equity markets actually had quite a positive final week of performance in the month, but it's still the worst month for global equity performance since the financial crisis, and actually the fourth worst month since 1969. So global equities finished the month down around 13.7%. In the US, we saw losses in large cap US equities of around 14% in the S&P 500. In Europe, losses of circa 17%, whilst in Japan, we saw losses of around 7% for the month. In the UK, larger companies delivered losses of just over 13%, but smaller companies delivered losses closer to 22%. In the corporate bond market, we witnessed losses of close to 7% in sterling corporate bond markets. US high yield bonds, riskier lenders with lower credit ratings saw losses of just under 12%. One of the biggest movers on the month was global oil price. That fell a staggering 55% in the month of March, whilst gold and other commodities saw relatively muted moves. Gold gained less than just 1% in the full month. Standout performers, meanwhile, were the government bond markets as investors sought safe havens. US government bonds delivered returns of around 3.6%. Positive returns for the month of March, and UK government bonds also positive for the month, returns of around 1.4%.
Okay, so after the big falls in the stock markets, lots of people are hoping there's going to be a rebound. What's your view? Have we reached the bottom?
Well, we have in fact seen a rebound off the extremes of the market moves that we saw in March. And as we've observed before, when markets are volatile, this means both sharp down movements, but also up movements as well in that same period. And bottoms in markets are notoriously hard to call, as in fact are the peaks in markets. However, it would appear from a market volatility perspective, we may be through the worst in terms of investor panic. That is, we know more today about the impacts than we did a week or so ago, but there is also still a lot we don't know. How long these lockdowns and the social distancing will continue for, how quickly the stimulus is having an effect in the economy, and how bad the damage really is at a corporate level. And those are things that we're really going to learn about in the coming weeks. So we'll be looking at high frequency data, the data that comes out more regularly, that allows us to sort of understand the impact in the economy. That's data such as the US weekly jobless claims data to try and gauge the extent of the economic turmoil thus far. But we really remain at a critical stage. Markets want to see containment measures that work. They want to see patterns in containment that are successful and a path out of the crisis, so to speak. So there are still risks to the downside, most notably that the US is yet to face the same degrees of shutdown as European countries. And we're still seeing a global rise in infection rates. But life is slowly returning to normal in Hubei province in China. However, the risk here, of course, would be if we saw any further contagion once normalization was underway. So, a so-called second wave of infection that results in then a further restriction on activity. I think if we begin to see successful containments and paths to normalization in countries such as China and South Korea, then that's really going to build confidence that there is a solution to the problem and that it can just be a temporary economic shock. In the meantime, we need that stimulus to really help businesses to survive, to keep people employed, and to limit the secondary effects of that activity shock on the global economy.
So hearing what you've just said, it's no surprise the news headlines are dominated by the coronavirus at the moment. But are there any other economic or financial facts and news that we should know about and take into account?
Yeah, well, I mean, the other major story from the month was all about oil, and that was a story that took markets by surprise. We had a significant move down in the global oil price in March, as I previously mentioned. And oil prices really had been under some pressure at the beginning of March and late February from reduced activity in Asia due to the initial outbreak of COVID-19. But it was really the failure of OPEC plus nations, of Saudi Arabia and Russia, to agree a collective strategy on managing the supply of crude oil and therefore subsequently the price, that led to a collapse in the oil prices as Saudi Arabia walked away and then rapidly increased production of oil. So oil fell at the beginning of March from around $52 a barrel down to around the $35 a barrel level. Now that increased production also came at a time of increasingly aggressive containment measures around the world that were designed to curtail the spread of coronavirus, and that has materially shifted the short-term dynamics in the oil market. And in turn, that's driven prices much lower. And we're now back to levels last seen in 2003 at around only $22 a barrel for Brent crude oil. And that's bad news for many producers of oil, for the companies and the governments who rely on oil revenues, because that demand has materially fallen at the same time that production has increased. So you've got a double whammy effect. And in fact, that might make the production of certain types of oil, such as shale oil in the US, economically unviable in some instances. But it's also good news. It's good news for consumers. Lower oil prices act as if consumers have received a tax cut. And for businesses who are large consumers and countries that are large importers of oil, this is great news because it's a key input commodity to their economies and their businesses, and it just became significantly cheaper.
Right. So bearing in mind, we're always building our portfolios for the long term. Even so, given everything that's happened in the market, what changes have you and the investment team made to the Nutmeg portfolios?
Well, we always seek to position our portfolios appropriately for the balance of medium-term risk and return. And we're cautiously positioned going into March. We held less in risky assets such as equities than we would expect to do over the long term. And we did reduce this risk further earlier in March, and we added to government bond positions in order to greater protect the capital in our portfolios. During the month, we also reduced our holdings of high yield bonds in the US. These are bonds issued by companies with lower credit ratings, and that was on the basis that an activity shock materially changes the affordability of debt for many of those companies. A large portion of those companies are in the energy sector. Clearly, the oil price fall will impact their revenues, but also there's exposure there to smaller sectors such as travel, leisure, and hospitality that are really being hurt at the moment by the activity restrictions that have been put in place. In addition, we also decreased our holdings of smaller companies in the US and Europe. Smaller companies tend not to fare well in recessionary environments, and we increased our exposure to large cap technology companies instead that have stronger balance sheets, larger cash positions, and that have business models that are focused on higher recurring revenue streams.
Right. So whilst we manage our portfolios for the long term and our customers are investing with us for the longer term, it's still informative to know how the Nutmeg fully managed portfolios have performed in the month.
Yeah, well, unsurprisingly, given what we've seen in global financial markets, it's been a volatile month for investment performance in Nutmeg portfolios. So for the month of March, fully managed portfolio returns range from around negative 2.8% in lower risk portfolios to around negative 11.5% in higher risk portfolios. In our socially responsible portfolios, returns range from around negative 1.7% at the lower end of the risk spectrum, through to around negative 9.2% at the higher end of the risk spectrum for portfolios. So some significant losses in the higher risk portfolios that contain greater equity assets, whilst those portfolios with significant allocations to government bonds have weathered the storm to a greater degree.
Okay. So for those of you who haven't realized, we are doing webcasts on a weekly basis now, and this month's customer question comes to us during one of our most recent webcasts, but we didn't have time to answer it. So James, I'm going to pose it to you now. The questioner, who chose to remain anonymous, asked, how many years will it take to recover to level performance looking at 2008 historical data?
That's a good question, and the answer is for one of our medium risk portfolios, for example, a risk level 7 portfolio, is that the total time from peak, the first losses being incurred to recovery, of all of those losses in the financial crisis would have been around 3 years. However, it's really worth considering a couple of things here. The total drawdown, that's the total negative, peak to trough performance move in 2008, was much more severe than what we've just witnessed in the past month. It was around a fifth higher for a portfolio of this risk level, losses of around negative 25% versus the around negative 20 maximum drawdown that we've seen since the market peaked in February in a risk level 7 portfolio. And I would also mention that it took significantly longer for that drawdown to occur in the first place in the global financial crisis. So we've just witnessed, as I mentioned earlier, the fastest bear market on record. And now whether we will test those lows again remains to be seen, but we've reached a lower point much earlier in the journey this time around. And that leads to another important point, and that's that it's really worth remembering that not all recessions are as long as 2008 and 2009. The drivers of recession tend to be different on each occasion, but the most painful recessions have really been those where there have been large economic excesses that have been built up and then need to be unwound. So for example, in the global financial crisis or back in 1929. And this is not about the buildup of excesses in a system. This is a supply and demand shock. It's about the sudden nature of a shock to activity. And that really helps explain why we've witnessed such sharp moves in markets. So if the virus can be contained effectively and stimulus can support the economy through the shock in the meantime, then there's every reason to believe that a recovery could begin a lot sooner than last time around.
Okay, thanks very much, James.
Thanks, Neil.
And thanks to all of you for joining us. We appreciate that this is a really difficult time, and we understand a lot of our customers have questions. If you do want to hear more from James and the investment team, as I said, we are hosting a weekly webcast every Wednesday at 11 a.m. Alternatively, feel free to contact us via email, social, or on the comment section. In the meantime, our best wishes to you, your families, your friends, and colleagues. Please stay safe, and we look forward to seeing you again next month. Thanks very much for joining us.